What the heck is EBITDA? You probably never heard of this word before, or even if you have, you need to know what it means if you're ever planning to buy a business. EBITDA in simple terms is just a number. It's how you figure out what a business really earns before taxes, loans, or personal expenses get in the way. Why is it so important? Because this is the number you need to understand if you want to know what the business is actually worth, how to come up with your offer, and how much money this business can make for you as the owner. Hey, it's Nandor, and right now I'm actively looking to buy small businesses. I've looked at dozens of deals, talked to tons of sellers, and one term that always comes up is EBITDA. At first, it confused the hell out of me. But once I understood what it really meant and how to calculate it, everything made more sense. So in this video, I'm going to break it down and walk you through what EBITDA means, what is an adjusted EBITDA, how it's calculated, and which number you use when valuing a business to create the best offers. So let's get into it. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So let's break it down. Earnings. This is the net income, the profit at the bottom of the profit and loss. Interest. If the owner took out a loan and is making payments, that's interest. So you add it back because you won't have that loan. Taxes. This is what they paid to the IRS. You will have your own tax setup, so you can add it back. Depreciation. This is when you buy something like a truck or a machine and spread the cost over time. It's not a real money leaving the business, so you can add it back as well. And lastly, amortization. This usually comes from buying another business. Same idea as depreciation, but for things like goodwill or intangible assets. Again, no real cash out. You take the net income and add all these back. That's how you get to your EBITDA. Now here is the key. There is EBITDA and there is adjusted EBITDA, also called recasted normalized EBITDA, but they all mean the same thing. And that's the number that actually matters when it comes to valuation and creating your offers. Adjusted EBITDA includes the add-backs for one-time expenses, personal spending, or anything that won't carry over to you as the new owner. Things like personal car expense. Let's say the owner bought a Porsche to go eat ice cream. That won't be considered as a business expense. Travel. Maybe the owner took a trip to the Bahamas to a 5-star hotel to relax. Family on payroll. Many owners pay their spouse or children a salary, but they have no involvement in the business. Maybe there was a one-time big lawsuit against the company and the company had to hire a lawyer and spend a bunch of money. But these don't reflect the actual operations, so you add them back. Adjusted EBITDA is what you use to value the business, not just the raw EBITDA. So whenever I'm looking at businesses, I always ask for the last 3 years of profit and loss, tax returns, and their most recent balance sheet. Everyone has their own process. But what I do is focus on reviewing all three, and I put the most attention on the profit and loss statement. Why? Because most small business owners do everything they can to show low income on their taxes so they don't have to pay so much to the IRS. So the net income on the tax returns is usually not the real number. So to find out what the business is really making, you want to look at the profit and loss because that will tell you the real story. You take that, go line by line, and identify what to add back. And that's how you get to the real earnings. So let me walk you through a deal that I just recently looked at. This was a pool company, and I have rounded the numbers to make them easier to follow. I look at the last 3 years of average. So the revenue was $2 million. The net income is $400,000. And we had a couple of add-backs, such as interest, $25,000. Taxes, $15,000. Depreciation, $10,000. And we have no amortization, so we put $0. That's how we calculated our EBITDA, which is $450,000. Now we add back some personal stuff. The owner bought a new car for himself for $30,000, and the owner also took a trip to Europe for $20,000. Adding back a total of $50,000 for personal expenses will give us the adjusted EBITDA, which is $500,000. This is the number I use for valuation. Most home service businesses trade at around 3 to 5 times of adjusted EBITDA. This one has been running for about 10 plus years and has a great reputation and recurring clients. So I use a 3 times multiple. So if you take $500,000 adjusted EBITDA, multiply it by 3, we have a $1.5 million valuation. Now you get a real offer you can work from. But here's the real takeaway. First, calculate the EBITDA by adding back interest, taxes, depreciation, and amortization. Second, calculate adjusted EBITDA by adding back owner perks and one-time expenses. Third, multiply adjusted EBITDA by the industry multiple to find your valuation. And then 4, that's your offer range, backed by the real numbers. And remember, I'm not a CPA, and I'm not some finance guru. I had to learn all of this the hard way by reviewing deal after deal. But the more you do it, the better you get. Thanks so much for watching. If you have been confused about EBITDA or unsure how to value a business, I hope this helped make things a little clearer. It took me a while to understand all of this, and I'm not an accountant, just someone who is in the middle of figuring this out by looking at real deals every week. But once it clicked, it completely changed how I looked at businesses. Now I can spot good deals faster, avoid wasting time, and actually know what to offer. I'm sharing everything I learned while buying my first business, so you don't have to figure it all out the hard way. Keep going, you're closer than you think, and see you in the next one.